Hey everybody, welcome to CoveredCall ETF Investing. And for today, what I wanted to show you all is something that many of you have picked up on here in the month of January in 2025. You see, I've built a tool called the CoveredCall ETF AllStar Tracker. I've been running a promotion, $50 for a 1-year membership, so that you can get a brand new tracker every single month. I often use this tracker in my content to look at things like distributions and average volume and the growth of AUM, yields, how the percentage of distribution increases over time. And there's a lot of detail there. Of course, we can't forget about performance. So it's a great bird's eye view overview tool that you can easily filter to compare against indexes and other funds. And in this month, because the tracker turned 1, I am offering 68% off. I would have done it through Patreon, but they wouldn't let me do more than 20% off. So that absolutely bugged me. I thought that was not good enough. So what you guys deserve is 68% off. And so that will change come February 2025. But not to worry, I'll be kind of running, little micro promos throughout if for some reason you missed it in January of 2025. So just look out for those announcements in my community tab or in my various videos. But what I wanted to do here, especially to honor the people that have poured into this thing, and I know the people that will come on board with it. I wanted to do a full run through, and I'm going to make it lightning fast just to compress the time on this kind of video. So it might look a little rough, but when you guys go through it, it's going to be rough if you're doing it for the first time. And so what we'll do is we're going to build a portfolio using the tracker, look at opportunities in the various different little market cycles, 1 month, 3 months, 6 months. And then we're going to take that data or take that portfolio. We'll look at the tax stuff. We're going to just copy it and we're going to pour it into a tax calculator. It's one of my favorite ones. It's by Wealthsimple. And of course, with Wealthsimple, they make it simple. So without stalling anymore, let's run. All right, so since many of you have picked up the tracker, since this promo has been going on, $50 for a 1-year membership, to receiving updated trackers every single month on the first of every single month, I thought it would only be fitting that we also dive into how to use this tracker in a much bigger, broader detail. And there's no better way of doing that than building a portfolio and using taxes to figure out what the cost would be taxes wise, what the opportunities would be. So this is obviously, I've done something like this before, but let's kind of update everything, where I build, say, my own portfolio for when I get into a non-registered account. And that's really what I want this to mainly focus on. If it's in a TFSA, we're not worried about the tax implications, but if it is inside of a non-registered account, a taxable account, we do care about taxes a great deal. But I also treat this as an opportunity where you're looking at this for the first time and how you might initially be thinking about it, how to find opportunities, and then build a portfolio, test the tax situation. So let's get into that right now. If you get the tracker for the first time, and hey, hopefully you get it while the promo is on, $50 for 1 year. After that, in February and beyond, it'll move higher. I'll probably do little micro promos here and there, and to knock the price down just a little bit further, but those will be sporadic and you'll never know when they're coming. But let's just say you get the tracker for the first time. What you're going to want to do is highlight row 2. If you can't, for whatever reason, if you can't see it, just highlight row 2, and then you go up to data, and then you just click on filter view, and basically every column in row 2 will have a filter function. So naturally, many of you are going to want to filter by yield first, I would imagine, the forward yield, which is the current distribution multiplied by the next, say, 12 months. If we assume the distribution is stable, the more accurate yield is the trailing 12 months. It's the distributions that have already come out, have been established over the course of the last 12 months. So anyway, Z to A, that's what you want to click on. And this is how you get sort of the list of all the various ETFs in here. Now, one thing that I kind of jumped the gun on is I already had this filtered by all-in-ones and diversified funds. So let's try it now with all the funds in there, which should be roughly around 170-ish funds in here. So loads above 10%. If you're American watching this, we're currently looking at Canadian funds. I do have a tab that's for Americans and a bunch of other tabs that, even if you're American and Canadian, it's all shared information, whether it's AUM, yield, average monthly volume, distributions. The only thing that just has Canadian only data on it is the 2023 taxes. So anyway, let's go back up to here. What do we want to look at next? Probably opportunities. This is a section where you can filter by performance, Z to A. That allows us for top to bottom performance. And usually what I like to do is in any given, say, 6-month period, 3-month period, 1-year period, is I like to go to the bottom, not just to see the individual funds that are weaker. By the way, if you're wondering why certain cells are yellow, that just is an easy indication to let you know that there is no live data for these particular cells, because this data is changing in the performance section and in the daily quote section, which is basically over here. So a lot of this is all live data, including the yields. They all change based on price performance, or as the price changes, I should say. Then obviously your price performance changes, your total return changes, your yield also changes as well. It goes higher if price moves lower, especially if the distribution is just continuously stable every single month. So over the last 6 months, this is weaker, but what makes, say, this section a little bit more powerful is what sectors are actually the weakest at the moment. And you can see that we got healthcare, bonds, and a little bit of energy in there. So that's one quick way of just deciphering what kinds of sections are a little bit weaker. But for our cases and this example portfolio, let's get actually building. Let's actually get building some all-in-ones here. So we're gonna go to tickers. We're gonna add in all the indexes just to compare it to. I pretty much know what funds I want to invest into a taxable account. We're going to do QQCL for some growth, USCL for some growth. I want to do HDIV for an all-in-one that's mostly Canadian focused, 75% Canadian, 25% American. I also want to do ENCL. I want to do, I take it bank. And then I'm kind of debating between UMAX and UTES. We'll do UMAX just because we don't have tax data for UTES. So I'm just going to put UMAX in there. Okay, so let's filter this by, there we go. Okay, so we have our portfolio. This is what it is. So far, what do we got? 6 funds. Now, if it was equal weight, I know it's not going to be equal weight, but for the purposes of this video, let's just make it equal weight. The yield's going to be around 13.85%. I can tell you the yield will be higher. My target yield for this portfolio is around 14%. So we're close, and we'll just go with that for now. And I'm targeting a portfolio to invest of around $150,000 after the sale of my home to support a rental house. Okay, so that's our average yield. Again, if you want to see average yield, all you got to do is just highlight, go down here to the sidebar. You might see some in the corner there, but you just head to the average. Now, sometimes the percentage might not actually show up. If that's the case, either way, what you might see is 0. You'll see 0.1385. That that will be your 13.85%. Okay, so just so you know, if you see a number down there that's different or looks different, just keep in mind that's just the yield. It's there. It's just the decimal place has just been moved over. So let's actually also compare 1-year performance with a portfolio like this. This is one of the fun things in building a portfolio is you get to actually do. Over the past year, this has done 10.78%. But again, CoveredCall ETF, not exactly known for their price performance strategies. This entire portfolio, if it was equal weight, would have underperformed pretty much everything else. No, the real power is in the total return. So just check that out. It went from 10.7 whatever percent all the way up to, if you include the distributions and you were reinvesting them, up to 26.9%. That beats out the the Canada's S&P 500, which is the TSX 60. It beats out the S&P 500. It beats out the Russell, beats out the Dow Jones. What it doesn't beat out is, and it's about 2% off from the total of the NASDAQ 100. So a pretty well-performing portfolio overall, especially because it's heavy in some Canadian sector funds, which I want for tax benefits, but I do want a little bit of growth in there, and I still want that roughly target yield of 14%. So now that we've tested that, let's move over into taxes, and we'll just filter everything through here. So click on ticker, clear out everything, and we want to do QQCL, we want to do USCL, we want to do HDIV, ENCL. By the way, these pretty much all have 25% leverage. The only thing that doesn't have 25% leverage is UMAX. The nice thing about incorporating some 25% leverage, some light or modest leverage for the long haul, is that leverage has a way of counteracting the capping of the upside effect that covered calls usually have, right? The cap growth to a certain extent. Well, the leverage sort of acts as a way to get around that. You could kind of think of it that way, right? So covered calls drag on price. Leverage helps to alleviate that drag over the course of time. So that's why 25% leverage over the long term is more of your ally and not your enemy, okay? That will result in a higher MER, which is the management fees, and mostly that includes all of the different fees in total. But sometimes not everything. So that's also important. MER, usually it's everything, but things like trading costs could be calculated outside of the MER. So keep that in mind. So 6 funds. So what you're looking at here are 2 different sections, and we have the total distributions for each unit and how that's broken down, and then I also can show you what that looks like by percentage. This section really helpful. I usually like to look at the percentage, and especially at return of capital, because return of capital is the most tax efficient. Essentially, you're not paying tax on any of that portion of the funds. So just understand, the total distribution per unit is broken down into all of these sections, whether it be foreign tax withheld, foreign income, other income, capital gains, eligible dividends. Now with return of capital, yeah, it might be tax-free. There's always usually controversy around return of capital because that means your principal is coming back to you. Just understand the fund managers have, right, they got mechanisms and they can manufacture the way in which these things are paid out. Tax loss harvesting is maybe more of a common example of how they can make these funds a little bit more tax efficient. But nonetheless, if you were to hold these funds for a long period of time, I've also calculated in here, if you were to say hold these funds for years and years and years and only lived off the income, you never reinvested and you never sold anything off, This is roughly how long, roughly, I can't stress that enough, roughly how long it would take for the return of capital to transition into capital gains. Now I have a whole playlist of videos that talk about capital gains. I should say return of capital, how it all works, and to give you all a better education on exactly how this works. Because if you're just looking at this for the first time and you probably just don't understand exactly what's going on there, go to that playlist, go through those videos. They will help you to understand what you're looking at here as far as the tax section. And you go through those videos, maybe you come back to this video, to the tax, calculating the taxes here. It's going to make way more sense. I'm telling you, this is just part of the exercise of becoming a much more independent, confident income investor, help you all get over that learning curve. All right, so we can see return of capital makes up the bulk of many of these funds. And just at a glance, I can already tell, okay, these are going to be really tax efficient. So really excited about that. The next bit of, I would say the next tax favorable is either going to be capital gains or eligible dividends. I can't exactly place this is definitely more than the other, because capital gains, it is more tax efficient than eligible dividends. The higher the income ladder you go, eligible dividends much more tax efficient if you're on a lower rung of that ladder. And then we can cap it all off with other income and foreign income, which is going to be taxed at your marginal tax rate. So now that we have this information, we're confident in this portfolio, we're looking at, again, a non-registered example portfolio that I'm looking at investing into. I do have like another portfolio that's very similar to this, where I do include that new HHIS fund in there as well. So, but I can't do it for this example because HHIS just came out as of the recording of this video, and I also don't have tax information for it just yet. Okay, so what we want to do is you're going to want to open up a new Google sheet or an Excel sheet, whatever you want to do with that. And let's take eligible dividends, highlight these rows down to there. Let's copy this whole section. So now that we have copied and pasted the values from the tax factor summary into this new Google sheet, what we're going to want to do first is calculate what is our total portfolio multiplied by the expected yield. So this $21,000 based on a $150,000 portfolio at roughly around 14%, that's going to produce $21,000 a year. So to get the breakdown of all of that, the rough breakdown that we can feed into the tax calculator, this is what we're going to want to do. You're going to want to sum up everything first. So that's exactly what we're doing here, because these will be the total numbers that we plug into that calculator. So all you need to do is hit equals. It'll assume that you just want to add up everything in the columns right there. So now that we have all of that added up, we also want to produce distribution totals that get us at least close to that total payout. Again, this is rough numbers. Bring all the specific numbers and everything to your tax professional. This is just it's just for the exercise, for demonstration purposes only. So let's highlight the cell, equals G8 in this case. So that's what you want to do. Whatever you're trying to multiply or get, you got to do it by G8, or you can do it by the particular cell. In my case, it's G8 multiplied by, let's call it, what is 23,000? Right? So we're just trying to plug in a number that gets us close to 21,000. So let's try 3,000. It gets us closer. Let's do 3,100. Okay, that's pretty close. I take it 3,150 is that basically gets us the closest we can possibly do. So we get a number that's close to the total distributions, 3150. So what are we going to do with all these other ones? We are going to do 3150. So because we did it once, Google Sheets, it just intuitively already knows that's what we want to try to calculate for all these other cells. So we just have to hit equals and then just tap on the formula that it gives us. Okay, so now that we total that up, and it should come out to 21,125. Again, we're using that number as a proxy, as roughly something that's close to the $21,000 in distributions that we're going to be using. So now let's start plugging these numbers into the calculator, and then we'll start filling out what the tax breakdown is. So we're using the Wealthsimple tax calculator here. I like it because it is just that. It is simple. So we want to click our province. Let's see, what is total taxes paid, whether it's both provincially, federally. You're going to be paying, if you live in BC, $24,759. So we'll put that number into our spreadsheet here. Okay, if it's hard to see, I'll kind of move it over a little bit. And now let's plug in all the numbers if you live in BC. What are the taxes going to cost you? So let's start with eligible dividends. We'll copy that. Head down to eligible dividends, that section. Let's copy and paste it in there. Let's just kind of get rid of the, whoops. Let's just get rid of that. We'll do capital gains. And we'll plug that right here. Actually, so there's two sections here. If you're not aware, back earlier in 2024, there was the government wanted to do a new inclusion rate for capital gains. Instead of 50%, they want to make it 66%. That hasn't officially become a law yet, even though it shows it here, because of the proroguing of government right now. At the time of recording, basically all bills that have been introduced or that are sort of in limbo awaiting to get, what do they call that, ascension into law, it basically gets dropped. It all has to be reintroduced because of the proroguing process here in Canada, where basically the Prime Minister can just shut down the government. Okay, so but the wrench that gets thrown into this is that the CRA, the Canadian Revenue Agency, they are treating that new inclusion rate as if it was law. So it's just a mess up here in Canada when it comes to this kind of stuff. But honestly, the inclusion rate really only matters if your capital gains are over $100,000 or $250,000, if that was to actually become law. So in our cases, that doesn't matter. The inclusion rate is still 50%. Now, there is no section that says foreign income. It's just other income. So if you were to calculate this, all you really want to do is just add up the two. We can see the sum over here is $1,630, $1,630, $1,630. So we've plugged in our numbers. That's everything we really need to get a rough idea. This is how much this portfolio is going to cost me. So we'll put that number right there, just so we can see the difference between $100,000 of income and how much additional. So this would be the total taxes paid with the $100,000 income with the $150,000 portfolio. I would really just be paying, what is that? It's like under $1,000 in taxes, right? Under $1,000 in taxes extra that I'd pay. Now you might be wondering, how come we didn't factor in any return of capital? There is no section for return of capital. It is essentially just tax-free unless you hold it for a long time, and that can transition into capital gains. But if you wanted, for the sake of the exercise, if you're like, well, I plan to hold this thing I'm going to live forever, then you would want to add in return of capital with the capital gains total. So that's what you would have to do there. So, okay, now we've calculated BC. How much would this portfolio cost if we were to do it in Ontario? See, most of you live in Ontario. Let's figure that out based on a $100,000 portfolio. So we got $26,136. Let's plug that number into here. So just remember, this section doesn't include any investment income. It is just strictly your employment income. So let's feed in the numbers once again. Eligible dividends. Go down to eligible dividends. Remember, it's just 3 sections we're filling out. Do capital gains. Where's capital gains here? So if it's under $250,000, if you mistake it and you put it here instead of there, it doesn't matter. It's going to be the same for you if it's under $250,000. Okay, we want to add in these two. That's the 1630, roughly, under other income. 1630. All right, the moment of truth. What does this get you if you live in Ontario? 26,852. Okay, so I mean, I wonder what the difference is. So anyway, you pay a little bit more in, you certainly pay a little bit more in Ontario, but overall, like, it's pretty negligible wherever you live. Your employment income is the real factor in all of this, but based on your capital gains, eligible dividends, and all that other income, it's quite tax favorable. Even at $100,000, whatever marginal tax rate that falls into, I want to say that's off the top of my head, 38%, something like that, in and around, maybe that ballpark, maybe slightly less, but somewhere in and around there. So quite tax favorable. It's especially with a non-registered account as a Canadian, having some Canadian stuff in there can certainly help you out, while you also get a little bit of growth as well. So for me, that will come in the form of USCL, QQCL, and that small component that's part of HDIV. So let me know what you think in the comments down below, and pick up the tracker for yourself so you can, calculate away and figure this stuff all out for yourself. So hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.